The secrets to profitable Forex trading. Welcome. It's a pleasure having you here. Ensure to pay full attention and take notes as we proceed. It promises to be enlightening. Why are you here? This is a very important question, and we want you to give us your answer. You can pause this video here and then give that answer. Let me help you out. You are here simply because of money. Yes, you are here simply because of money. If it's not because of money, then of course you can as well turn off and then go and do something else. So you are here simply because of money. Now I want you to close your eyes and picture yourself with respect to this money, where you see yourself in the next 3 to 6 months. Close your eyes. Picture yourself with respect to this money that you want to make next 3 to 6 months. Do you like what you see? I'm sure the answer is yes. Great. So when do you want to make this money? When do you want to make this money? I'm sure your answer is now. Some of you might even be saying yesterday, as soon as possible, pronto, and the rest of them, right? So you want to make the money now. A quick disclaimer for you. You are here for money, but kindly note that you can also lose money, or rather, let me put it this way. You are going to have losses. It is not a curse. It is part of the business. It is for you to ensure that those losses are well minimized, and then when you make profit, the profits are well maximized. I repeat, minimize your losses and then maximize your profit. And then also, as another disclaimer, the information that we are going to be giving you now is not going to guarantee success. What will guarantee success for you is the application of the information, is the implementation of the information, is the practical aspect, meaning that you must practice. Very, very important. Now moving on. A quick one into my Forex journey. My name is Tolu and I've been trading for a few years now, over 10 years to be precise. And it hasn't been, easy, so to say. At the very beginning, it was a thing of a lot of losses, a lot of crashed accounts. And I'm sure you listening to me, you can relate with what I have just said. For a lot of years, nobody to show me the ropes. I had a lot of losses, a lot of crashed accounts. But then I continued, and I continued simply because of my family. All I really wanted to do was to find a stable source of extra income in order to provide a better life for my family. Look at the smiles on my wife and my 3 kids. This is what motivated me. This is what kept on, pushing me to move and to continue to do what, I needed to do. Because it's a thing of quitters will never win and then winners will never quit. And then I continued, and then I've been privileged to work for a few brokers where I've been able to train thousands of traders, both offline and online, right? And of course, I have learned a lot and I have grown. And then now I help new and struggling traders read and understand the market like an open book for profitable trading. I repeat, I help new and struggling traders like yourself read and understand the market like an open book for profitable trading. Agenda for this course, agenda for this video that you are watching. We're going to discuss the A to Z of Forex trading. We're going to discuss everything you need to know about the business in order to be profitable. We're going to show you how to trade, meaning that we're going to also go through some practicals and then we'll use some examples as well. And if you need further help, you need further assistance, don't hesitate to contact me for mentorship. I have mentorship programs that will bring you up to speed as well. 3 secrets to profitable trading. What are the 3 secrets to profitable trading? Secret number 1, you don't need a lot of money. Yes, you don't need a lot of money. Some people believe you need $1 million or $10 million in order to start the business. No, you can start with as little as even $100. The truth now is that if you cannot manage small money, you cannot manage big money. Do you agree with that statement? I repeat, if you cannot manage small money, you cannot manage big money. So why not start small? And that is the truth. So you don't need a lot of money. With what you have, start, test the waters and see how it goes, and then proceed from there. Secret number 2, it is not too hard to understand. I repeat, it is not too hard to understand. Do not feel threatened by the colorful lines. We're going to explain the business to you, and that's why you are here watching this course. From the explanations, you will see that, oh, it is actually straightforward. Interesting. Secret number 3, this is not time consuming. This business is a 24 hours business. It's a 24 hours market, but you do not need to trade every day. There is indeed a fine line between gambling and trading. And I can tell you for a fact that a lot of people are gambling. You watching this video now, you are more or less gambling. So we're going to help you to know how to trade the proper way in order to be a trader and not a gambler. Quick introduction to the business of trading. When it comes to introduction, we first of all start with what is trading. What is trading? Trading is simply known as what? The buying and selling of different instruments. Trading is simply the buying and selling of different instruments. Different instruments such as Forex, where we have the euros, pounds, Canadian dollars, Japanese yen, Switzerland francs, and the rest of them. And then we have commodities, charcoal, sugar, cotton. We have the cryptocurrencies, the Bitcoin, Litecoin, Dash, Shiba Inu, and the rest. Equities. We have the likes of Amazon, Google, Facebook, Tesla, Boeing, and a whole lot. Indices, you have the FTSE, the DAX, you have the NASDAQ, you have a whole lot of instruments that you can trade. You have the energies, the crude oils, you have the metals, the gold, the silvers. You have hundreds and hundreds of instruments that you can trade. So how do you make this money from trading? You will make this money from the price fluctuations, meaning that price should fluctuate, you can make money. And then the price could either fluctuate up or it can fluctuate down. If the price is going to be going up, then it is for you to be buying. And if the price is going to be going down, it is for you to be selling. This is one beautiful thing about the business. This is one major benefit about the business. You can make money when the price is going up, and you can also make money when the price is going down. Very, very beautiful indeed. It's all about knowing when price will go up and also when price will go down. That's why you are here paying full attention and also taking jottings. Now, when can you trade? You can trade in the morning, in the afternoon, and also at night. It is indeed a 24 hours market, so you can trade any time of the day. This 24 hours market, by the way, is broken down into 4 market sessions. We have the Sydney, we have the Tokyo, we have the London, and we have the New York. Sydney, Tokyo, London, and New York. This simply means that anywhere you are in the world, no matter what time zone you are in, you can trade based on any of these sessions and then end up making money. 24 hours, 5 days a week. Very important. Where can you trade? It's an online business, so you can trade from anywhere in the world. Anywhere in the world. Who can trade? Everybody, anybody, as long as you are 18 years and above, whether you're a doctor, a lawyer, farmer, student, engineer, whatever you are doing, you can do the business and make money. All you have to have is the right tools. You need the right tools for successful trading. What are these tools? The tools are, number 1, the internet-enabled device, which could either be your smartphone, laptop, desktop, or tablet that you are using to connect to this course now. So you already have that internet-enabled device. And number 2, you need internet. It's an online business. You already have that as well, as you're watching this online. So you need your internet as well. Number 3, you need the trading application, which is what we call the MetaTrader 4. You need the MetaTrader 4. We're going to talk about that shortly. And then finally, you need knowledge. Knowledge is the most important thing that you need. that would help you to be successful in this business. Without knowledge, you would more or less be gambling. And the good thing now is that you are getting this knowledge from the experience that we have been able to gather over the years. Yes, from all the losses, all the crashed accounts, we know the things to do and the things not to do. So we're going to show you how to do this the proper way, and it's going to help you to shorten your learning curve. You don't have to have all the losses, crashed account that took us years to get to where we are now. Yours will be at the snap of a finger within a few months. Oh, sorry, let me snap my finger. At the snap of a finger, within a few months, you get the hang of it, and then you start to realize good profit. How to trade? How to trade is actually the most important question, and that is what's going to lead us as we proceed now. 4 key elements of trading. What are the 4 key elements of trading? We have number 1, the trader, number 2, the trading strategy, number 3, the broker, and number 4, the market. The trader is you. Yes, you are the trader. I'm also the trader. Number 2, the strategy. This is the method of entry and of exits. You must have a method, you must have a strategy in order to enter the market and exit the market. So this strategy, we're going to talk about the strategy and even give you a strategy as we proceed. And then number 3, you need a broker. I repeat, you need a broker that will give you access to all of these instruments that we mentioned, the likes of the currencies, Forex, commodities, cryptocurrencies, equities, and the rest of them. The broker is the middle person between the trader and the market. You cannot access all of these instruments without a broker, period. And then, of course, the market is where we're going to do battle in order to make money. I repeat, the market is where we want to go and do battle in order to make money. So these are the 4 key elements to trading: trader, strategy, broker, and the market. The trader is trying to get to number 4, the market, in order to make money. But the trader number 1 needs number 2, a strategy, and then needs to use that strategy on number 3, the broker, in order to extract money. Now, by the way, we have a recommended and trusted regulated broker in the description in the comment section below, right? Most people at times say that the broker is giving them one issue or the other, but this one has been tried, has been tested, and has proven the test of time. And trust me, you need a good broker that will give you a fast enough platform, and then will help you to easily make your deposits and withdrawals without any issues whatsoever. Very important: deposit and withdrawals. Now, these are the 3 most important things that you need. You need number 1, strategy, number 2, risk management, and number 3, psychology. These are the 3 most important things that any trader needs in order to be successful. I repeat: strategy, risk management, and then psychology. Now, when it comes to the strategy is what is going to help you to enter and exit the market, enter and exit trades. You need a strategy for this. And then based on this strategy, we are going to be talking about the MetaTrader 4. This is the trading application. Don't forget, you need the trading application. We're going to talk about trading application shortly, and we're going to show you how to use it. And then market analysis. Market analysis is going to help you to eradicate gambling. Market analysis is going to help you to build and implement a trading strategy that you're going to use on the MetaTrader 4 trading application. Very important. So now, this is how the MetaTrader 4 trading application looks like. Maybe you have this already, or maybe you've seen this in the banking hall, or you've seen this on TV, but you are going to have this trading application. Don't forget, in the link in the description, there's a link there for a trusted and regulated broker that you can make use of in order to have this in front of you. And we number this number 1, number 2, and number 3. We're going to break down the software shortly for you to understand the environment of the software, and also how to use the software to open, close, and modify trades. This is the most important aspect of the software MetaTrader 4: to open, close, and modify. When it comes to opening of trades, you could either open a trade using now. You could enter the market now or enter the market at a later time. For now, it means that you are using the option market execution, and then for later, you are using pending orders. So you can enter the market execution now or pending orders. And then to modify trades in order to calculate for your stop loss and your take profit. Your stop loss is to prevent further loss, and then your take profit is to what? Is to acquire the profit that you have made thus far. And we're going to calculate stop loss and take profit using what we call pips, price interest point. Pips, price interest point, known as movement in price from one place to another, from point A to point B. And then also how to close trades. You can close a trade in either of these two ways. You can close it manually or you can close it automatically. The automatic way is you setting the stop loss and take profits, which is what we're also going to show you based on the modifying. And then the manual way is you doing it yourself. Okay, so this is the MetaTrader 4 trading application. And if you look over here, this is number 1, which is called the Market Watch, which shows all the instruments available and then the prices for buying and selling, right? And then number 2 here is called the Terminal, which houses everything that has to do with your money, your open trades, close trades. And number 3 over here is called the chart window, and this chart window gives us the graphical illustration of what is happening on the chart. So now to open a trade, we click on new order, and then this dialog box pops up, and then you have all of this here, symbol with all the instruments that you can trade over here. You have the volume. We're going to talk about how to calculate the volume shortly, so that you know based on your account balance that you are using the proper volume to use. And then stop loss and take profit. Stop loss is to prevent further loss. Take profit is to acquire the profit that you have made thus far. Comments, no need for comments, doesn't really make any difference to the outcome of your trade. And then we have market execution to place a trade now, and then we have pending order to place a trade later. So we're going to first of all show you how to place a trade now using market execution. So now we can click on sell on this price now, this current price, or we can click on buy on this current price, right? So we could do mini, money, more, and then click on buy to place a trade. Now look at what happens when we click on buy. Buy. Now can you see the trade here? It's showing on the chart window area, and this is the trade here as well, showing over here on the 2 terminal area. Now if you look very well, no stop loss and take profit is what is actually wrong with this trade. The trade is running now, so we're going to have to modify this trade in order to set the stop loss and the take profit. Now as we've placed that trade, I want to quickly show you something. If you look at the last digit here, it is smaller than the rest. So this is known as the pipette for selling, and then this last digit here for buying is smaller than the rest, and it is known also as a pipette. A pipette is a fraction of a pip. So it takes 10 pipettes to make 1 pip, and this is going to be crucial for our calculation. So let's dive into the calculation now, and let's see how that works. Now, in order to carry out this calculation for the buy USD card at 1.26837, now notice that we're using a stop loss of 30 pips and a take profit of 70 pips. In order to get the proper stop loss and the proper take profit, it is going to come from the market analysis. And as we have not done the market analysis yet, we are just going to be using arbitrary figures for now. So for the buy, for your take profit, you're going to be adding, so this is it over here. And then for the buy, for your stop loss, you are going to be subtracting. And this is vice versa for when you are selling. So for stop loss, it's going to be 1.26837. Don't forget the last digit here is a pipette. And then for the 30 pips, this is how you're going to be writing it. It's going to be 300. So this 0 is going to cater to the pipette value. So 7 minus 0, 7, 3 minus 0, 3, 8 minus 3, 5, 6 minus 0, 6, 2 minus 0, 2, and 1 minus 0, 1. And this is the stop loss that we have over here. And the take profit 1.26837 plus 70 pips. Don't forget 700, where this 0 caters to the pipette over here. If you write it at 70, you write it as 70, it is not going to be 70 pips anymore, but rather it is going to be 7 pips. So ensure not to make that mistake. So 7 plus 0, 7, 3 plus 0, 3, 8 plus 7, 15, 5 here, 1 here, 1 plus 6 plus 0, that gives us 7, 2 plus 0, 2, and 1 plus 0, 1. Now that we've gotten the stop loss and take profit values for this buy trade that we just took, now we're going to have to cross back to the MT4 to impute these values in order to modify it. So let's cross back to the MT4 in order to get that done. Okay. Now back to the MT4. Now from what we have over here, you can see the trade is without stop loss and without take profit. That's why it's reading 0. Now in order to modify this anywhere on that trade, you can right click and then click on modify. As you click on modify, you see the place for stop loss here and for take profit here. Now assuming we put only the stop loss 1.26537, you can see that while putting that in, this modified. So as a modified, it highlighted. So that means that if we click on it, it is going to accept it, and then this stop loss will change from 0 to this. So let's do that now. Modify. Beautiful. You can see the stop loss has changed, and then it remains the take profit. Now the same thing again, we can right click anywhere on that trade and then navigate to modify. Once we click on modify, now we have the options here, and then we can put the take profit here, which was 1.27537. Now you can see that this is highlighted again. So now we can click on the modify, and then voila, you can see the take profit has been changed from 0 to 1.27537. And if you check the chart window area, you can see this red line here representing stop loss, and then the red line here representing the take profit here as well, right? So now we've been able to successfully modify this trade. Now, how do we close this trade? We can close this trade in two ways: the manual way and also the automatic way. To close it the manual way, all we have to do, once again, on this trade over here, right click anywhere on the trade, and then you see close order. If I click on this close order, the trade is going to close, and this is the manual way. While the automatic way is what is the stop loss and the take profit that has been set over here. So once the price gets to stop loss here, it's going to close for that loss of 30 pips, and if it gets to the take profit here, it is going to close for that profit of 70 pips, right? So I'm just going to show you the manual way, as of course we can't wait for the automatic way. The manual way, right click once again, and once I click on close order, there you have it, the trade has closed. Now we're going to show you how to use pending orders. Remember, pending orders is to place a trade at a later time. Now you can see where the current price is, this current price here moving. Now assuming I want to place a trade to buy later, to place a trade to buy later means I am not buying at this current price. I could be buying at maybe 1.27240, or I could be buying lower at 1.26625, meaning I can be buying higher or buying lower. Now if we navigate back to new order and then we change this from market execution to pending orders, you will notice that we have buy limit, sell limit, buy stop, and then sell stop, and then we want to buy. So as we have two, one for buy limit and another one for buy stop, that means that one is going to be above while the other is going to be below. So which one is above, which one is below? Now this is it. In order for the trade where this current price is, in order for this current price to retrace, to pull back, to reverse, in order for it to come back and then continue in that direction, it is going to be a limit. A limit is going to be lower for a buy. A limit simply means that there must be a reversal. I repeat, there must be a reversal. So that means that at 1.26625, I'm going to have to use a buy limit and then put the price here at 1.26625. 625. Now, one way to test this further, well, if you feel, oh no, it's a buy stop, then why don't you change this to buy stop and see what happens? Remember we said for buy limit, it has to reverse. And then we want to test buy stop and see what happens over here. By the time we click on place, it said invalid stop loss or take profit, but then we didn't set any stop loss or take profit. So that means that the issue is not stop loss or take profit. The issue is what? The issue is this parameter. So we change it back to buy limit, and then by the time we click on place, voila, you have the 1.26625 1.26625 rather, that has been set as a buy limit. And if you want to place a trade above over here at 1.27240, that is going to be what? That is going to be a buy stop. So once again, we go back to new order, we change the market execution to pending orders, and then we do this 1.27240. You have to be the one to always change or rather put in the price you want to enter at, since it's a later price, it's a future price. And then don't forget to change this to buy stop since it's above. And then by the time we click on place, let's see what happens. Place. Aha, now you can see what has happened. Now we put a buy stop here, and then we put a buy limit below. This simply means that for the trade to pick this buy limit, it has to reverse, pick it up, and then continue to push higher. While the buy stop, there is no reversal, but rather a continuation, and then it picks you up here and then continues higher. So the difference between the limit and the stop is that for the limit, there is a reversal, while the stop, there is a continuation. Yes, so just in the case of the limit and the stop that we did for buy, we're also going to do this for sell as well. So for sell now, this is what we're going to be doing. For the sell limit, it means that you want the price to push higher and then drop. So for it to push higher and then drop, let's use this price here at 1.27650. That means that you want a reversal to this point and then it's going to drop. So a reversal here simply means that it is going to be a sell, what? A sell limit. So we click on new order. Once again, we change this to pending order, and then we change this also to sell limit, and then we put the price here of 1.27650, and then we click on place. You can also give this a test run. Voila, you can see you have the sell limit here. And then don't forget, for the sell stop, there is no reversal, but rather there is a continuation in that direction. That means that you just want the price to drop all the way. So let's use 1.26420 for this sell stop. So we're going to click on new order once again, and then we change this to pending order. And then don't forget, you will be the one to put the price of 1.26420, and then we change this to what? We change this to sell stop, and then we click on place. And then before you know it, you have it here. You have the what? The sell stop below the current price. If you look at what we've done now for the pending orders, we have the sell limit and the buy stop both above the current price, and we have the buy limit and the sell stop both below the current price. So this is going to help you to know how to use the pending orders. And of course, the pending orders is to enter at a future price. So this is the pending orders for you. Market analysis. Very important. This is going to help us to eradicate gambling. This is going to help us to place trades the proper way. This is going to help us to have a solid strategy. And we're going to be talking about market analysis based on fundamentals and technical analysis. We have the fundamental analysis and the technical analysis. And we always advise that you combine the two of them together. They say that two good heads are better than one. So we're going to first of all talk about the fundamentals, which has to do with news. Fundamentals based on news. When we say news, you already know news has to do with information. I repeat, news has to do with information. And then we have it as the scheduled news and the breaking news. Scheduled information and then breaking information. This information that we are talking about, you can get it from either the TV, radio, newspaper, or the internet. The good thing about the age in which we're living in now is that the internet comprises of TV, radio, and of course newspaper all together. So we're going to give you all of this information right now. When it comes to scheduled news, that word scheduled, it means what? Scheduled. You're expecting something to happen. That is scheduled news, expected news. And we have examples such as elections or events. Events could be maybe like the World Cup, or it could be like the Olympics and so on. You could also have news releases and so on based on scheduled news. And then breaking news, unexpected news, all of a sudden news, sudden disasters, tsunami, earthquakes. You could even have the death of a prominent figure, right? And we're going to give you examples shortly for you to understand this scheduled news and also breaking news. Now, whether the news is scheduled or the news is breaking, it could either be good news or bad news. I repeat, it could either be good news or bad news. Good news simply means we should be buying. And then bad news simply means that we should be selling. Examples of breaking news now. Let's flip through these examples. Earthquake in Japan. You remember there was this major earthquake tsunami in Japan, 2011. Was that good news or bad news? What would you say? Of course, that is bad news, Tolu. Yes, it was bad news. So because it was bad news, what do? We sell. What are we selling? We're selling the Japanese yen. You can see that wasn't difficult. That wasn't, brain tasking at all. It was straight to the point. Terrorist attack at the World Trade Center, 9/11. Good or bad? It was bad. What did we do to the US dollar? Sell. The economy came to a standstill and so on. Now, we found crude oil. There was oil boom in the US and also in Ghana some time ago, 2011. Was that good or was it bad? It was good. What do? You buy. Nelson Mandela's death, December 2013. Was it good? Was it bad? I'm sure some of you might be thinking, I might be saying to yourself, oh, it was good. Oh, it was bad. Now, let me explain it. This Nelson Mandela's death, we already know Mandela, right? Mandiba. His death was good and was bad. Yes. So if you said good, you are correct. If you said bad, you are also correct. Let me explain further. For good, what happened? A lot of people traveled to South Africa. As they travel to South Africa, they're going to be spending which currency? The South African rand. So that means that South African rand would have been in high demand and it would have been a lot of buying. So for you, it was good. You'll be buying and then you sell when? Expensive. That is business for you, right? And that was during the burial ceremony period for a short period of time. Now, for those that said bad, those as an example were the foreign investors that were in South Africa. They would have looked at it and then said, Mandela's death is not good. Why? Because we don't know what's going to happen next. And because of that fear of uncertainty, you'd have had a lot of companies leaving South Africa and then going to maybe Ghana, going to another country. Now, as they were doing that, what were they doing to the South African currency? They would have been selling the South African currency heavily. Exactly. And they would have been doing this not for the short period of the time, not for a short period of time, but for a lengthy period of time, maybe like for months and even years. And then lo and behold, what happened in South Africa after Mandela's death? We started having pockets of what? Xenophobia attacks, meaning that it kept on increasing. And then what happened? The economy came to a standstill. So that means that if you understand any information based on good, then you know you should be buying, whether for short term or long term. And if you understand that same information for bad or whatever the situation might be, you know you should be selling for short term or long term. Nelson Mandela's death is a typical example. Now, when it comes to coronavirus, this is something that everybody in the whole world, we are aware of coronavirus. So this coronavirus effect, when we had lockdown, March 2020, remember we had lockdown all over the world globally in trying to slow down the pandemic, right? What do you think happened to the shares of Netflix? I repeat, what do you think happened to the shares of Netflix? Did it go up or did it go down? If you're thinking about it very well, you know during the lockdown, it was a thing of no movement, social distancing. People were indoors. So what were they going to be doing? Watching movies, watching series, and then they would have been subscribing to the shares of Netflix. That means that the shares of Netflix is going to go up. Then that is when we're supposed to be buying Netflix. You remember, you understand the information, you take advantage of the information, you use it to make money. This same coronavirus effect, the lockdown on crude oil, that same period, the lockdown period on crude oil, people were not going out. So no exporting of crude oil, no buying of petrol. What does that mean? There would have been excess supply of the crude. And then of course, excess supply means what? Selling. And this was even the period where crude oil crashed, crude oil tanked. We had crude oil get to about $0 per barrel. Did you hear that period? That was even the same period that we had it for the WTI, where it got to minus $37 per barrel. I'm sure you heard about that. That means that based on this breaking news, this information we're talking about, you would know whether it is good or you will know whether it is bad, and you will simply take advantage of it. Now, when it comes to scheduled news, examples of this scheduled news, we talked about news release, events, elections, and so on. We can get all of this information from the likes of Bloomberg. Bloomberg has its own TV, also has its own website. You can get this information from Realtors. You can get the information from investing.com, from Forex Factory, from MarketWatch, from FX Street, from Forex Live, from BK Asset Management, from lots and lots of websites that you can get all of this scheduled news from. Now we have this popular website known as Forex Factory, and we are going to be looking at the website forexfactory.com in order to understand and interpret the information from there. So we're going to dive into that now. So you can as well go over to your forexfactory.com website and then look at all the information. We're going to show you how to interpret it in the fastest way possible. Here's the Forex Factory website, and as you can see right in front of us, we have the necessary information that would help us to interpret the news. Now you can see the date over here. You can see the time in which all the news came out, as you can see, and you can see the currencies that has to do with the news. And then you have impact over here. For impact, if you look very well, we have yellow, which stands for low impact, orange, medium impact, and then red, high impact. Now it is the red news that are the ones that carry a lot of volatility. So you need to be careful with all of them. And these are all the news that we have over here for all of these currencies. Now we have details where we can get more information, but I'm just going to show you how to quickly interpret this news without wasting much of your time. You have the previous here, which is giving you the previous news release for this particular one, probably last month or last week or whatever. And then you have the forecast. The forecast is a prediction. You're predicting that it's going to be 0.5%, but you don't work with the forecast because the forecast could easily be misleading. You have to wait for the actual to come out. Now, when the actual comes out, as you can see over here, we have 0.9%, and this actual is going to come out at this time, 1:30 a.m. So when the actual came out, what you should be looking at is the color of the actual. You can see that this actual is green. So green simply means that we are going to be buying. Right? Green simply means that we are going to be buying. Over here, there is no actual. Don't forget, it is the actual that we're after, not necessarily the previous or the forecast. So this actual here, 3.0%, it came out at 8 a.m. It is also green. So green means that we're going to be buying. So we're buying this currency in question. Now you can see that we are buying this currency euro. You can always pair with another currency. And we're going to talk about the pairing shortly. Now we have 0.8. And this 0.8 is black. So black is neutral. Neutral means that you are not buying and you are not selling. Over here you have green, which means buy. Here green means buy, and then green means buy. Black, neutral, black, neutral. Finally, we have red. Red means what? Red means sell, right? And then red means sell, red means sell. Green, okay, no, black, this is black. Black is neutral, black is neutral, and black is neutral. Now you can see from what we have over here, you are after the color of the actual figures when they come out at this particular time. So this is how you're going to be interpreting this Forex Factory. It's going to help you to know whether you're going to be buying or selling, or maybe not even doing anything for the ones that are black. So this is how you're going to be interpreting this. And then when you get what you're going to be doing to one currency, then we'll now pair with another currency. So we are going to show you how to pair with another currency now. How to pair two currencies, currency pairing. Now, after getting the information that it is good news or bad news, you need to pair one currency against another currency. I repeat, you need to pair one currency against another currency, and that's called currency pairing. So as an example, in front of us, we have X and Y. X is known as the first currency, we call it the base currency, and then Y is known as the second currency, which is what we call the quote or the counter currency. Now you could either be clicking on buy or clicking on sell. I repeat, you could either be clicking on buy or clicking on sell. When you click on buy, which of the two currencies are you buying? When you click on sell, which of the two currencies are you selling? Look at it this way. When you click on buy or you click on sell, you are always attacking the first currency known as the base currency. So when we click on buy here, if you look, we're buying X because X is the first currency. And of course, we're doing the opposite to the second currency. So we are selling Y. Now, when you click on sell, you are selling the first currency, which is what? X, the base currency. So we're selling X. What are we doing to Y? We are doing the opposite, which is what? We are buying Y. Look at this section very well. Currency pairing, very, very important. When you get information on one currency, you can easily pair it with another currency of your choice, any currency of your choice. It is up to you at the end of the day. Now, these are a few examples of this currency pairing for you to understand more. Now, let us assume that we have information telling us to sell CAD, the Canadian dollars. Let's assume that we have information telling us to sell the Canadian dollars. And then we have a currency pair such as the USD CAD. USD CAD. We know we're selling CAD, don't forget, so we're selling CAD. And then what are we doing to the USD? We're buying the USD. I repeat, we're selling CAD. What are we doing to the USD? We're buying the USD. And because the buying is the first thing we're doing, we are going to be clicking on buy. So you can see it is going to be a thing of we click on buy USD CAD. When you click on buy USD CAD, you are buying the first currency, which is USD, and then you are doing the opposite to the second currency, which is CAD. And then when we have the currency pair CAD JPY, remember we're selling CAD. So that means that we're selling CAD and then we are buying JPY. So now we click on sell, which means that we're selling CAD to buy JPY. Now another example, assuming that we got information telling us to buy GBP, the pounds, telling us to buy pounds. Now we have Euro GBP and then we have the GBP USD. Don't forget, the information we have is buying GBP. So buying GBP for Euro GBP, it means that we're selling euros and then we are buying GBP. It means that we're selling euros and then we are buying GBP, right? And as a result, we're going to be doing what? We're going to be clicking on sell. As a result, we are going to be clicking on sell, which will be sell euros, and then the opposite is what? Buy GBP. And then when we do GBP USD, you remember we're buying GBP, so we're buying GBP, which happens to be the first currency, and then we're selling the second one, USD. So we click on buy. So that is buy GBP in order to sell USD, right? And that is what we have over here. Now, let's even take this further, because some of you might be asking, what if we have information telling us to sell the Canadian dollars and then telling us to also sell USD? Now look at it this way. If you have sell CAD and sell USD, you cannot sell one currency to sell the other currency. So that means that for USD CAD, We cannot sell USD and then sell CAD. So we don't do anything. We cannot pair those two currencies together. So what you can do, you can pair CAD against another currency, and you can pair USD against another currency, but not USD against CAD, not CAD against USD in this instance. And then when we have another information, as an example, giving us giving us buy GBP and buy euros. Buy GBP, buy euros. It simply means that we cannot pair GBP and euro together. We cannot be buying euros to buy GBP. It's not possible. So what we do is what? We pair GBP against other currencies, and then we pair euro against other currencies. Are we together? Hope you're understanding. Good. Then let us proceed. Technical analysis. Now, the technicals has to do with price action and support and resistance. Price action is direction and trend. Price action is helping us to understand the behavior, the movement of price. Support and resistance is going to help us with the entry and also exit. Don't forget, we need to combine the fundamentals and the technicals together. Now, this price action that we just said is the direction, is the trend, is the movement of price. Looking at what we have right in front of us, who can help us? What is the direction? What is the trend? You know, you're going to be looking at everything from the left-hand side to the right-hand side of the chart, right? And you can see we put some arrows going up, down, up, down, up, down, and all. So as you're looking at the whole entire chart, you should be able to identify that the price action is up. This is an uptrend. This is an up movement, right? And that's what the price action is right in front of us. Now, speaking of this price action, we have it in three chart views. We have it in the line, bar, and the candlestick chart views, and you can see how they look like. Now, most traders prefer the candlestick chart views because it is easy on the eyes compared to the remaining two. And when it comes to the candlesticks, you can see to the left hand side and to the right hand side, one is representing the sellers and the other is representing the buyers. So which one is for the sellers, which one is for the buyers? If you look very well, they're all comprising of the open, the close, the high, the low, upper shadow, lower shadow, and then the real body. For you to be able to determine whether this candle is for the buyers or the candle is for the sellers, that has to do with the relationship between the open and the close. I repeat, the relationship between the open and the close. Now, based on the open, if it should close above the open, that is what? That is more or less up, which is for buyers. So that means that the first real body for the first diagram that we have to the left hand side, it is indicating a buyer's candle, while the other one to the right hand side, you notice that the close was below the open. So this is for the seller's candle. So this was going to help you to be able to determine whether it is the buyer's candle or the seller's candle. So it also doesn't depend on the colors. You can use any color of your choice. You just need to be able to read and understand the candles, and then it will give you that information that would help you to enter and then to exit, right? And that's why if you notice on every chart you have different candlestick formations, different candlestick patterns, and so on. But some of them are giving you some certain information, telling you it is time to buy or telling you it is time to sell, or even giving you information of indecision. For the ones that we have in front of us, the bullish engulfing is trying to tell us bullish engulfing. It means that it engulfs the previous one in a bullish way. And when we say bullish, bullish is to the buyers. And when we say bearish, bearish is to the sellers. So bullish engulfing means, oh, the buyers are in control. It is time for us to enter to buy. You can see that the price action is helping us with the direction. And then this one, bullish engulfing, is helping us with the direction of buying, which is up. Bearish engulfing helping us with the direction of what? Of down. If you look at the remaining candles or candlestick formations that we have here, they're most likely telling us up or down direction. And that is how powerful these price actions are. This doji that you have, the last one over here, the last candle, the doji, is a neutral candlestick pattern, is a neutral pattern telling us that the buyers are not in control, the sellers are not in control. It is more or less a stalemate, right? And then based on these candlesticks that we're talking about now, looking at the most important ones that people normally pay attention to, the likes of the bearish pin. Bearish pin is signaling that it is time for it to go down. Bullish pin is signaling that it is time for it to go up. Bullish engulfing, don't forget bullish is to buy, so it's telling it's time to buy. And then bearish engulfing, bearish, time to sell, is signaling you time to go down. So all of these are indicators of the direction, whether it's up or down, and we need to pay full attention to all of this. Now, when it comes to the support and resistance under the technical analysis, it is simply going to help us to know exactly where to enter. These are like the bus stops, like a bus moving from one park to another park, from one terminal to another terminal, from one station to another station. This is going to help us to know where exactly to enter to go in that same direction of either up or down. So support is where we have demand greater than supply. Support is where we have demand greater than supply, and this simply means that the price is going to be going up. Price is going up. And you know, when we say price is going up, that is for the buyers. That means that for you to buy, you are going to be buying at an area of support. You are going to be buying at an area of support. And then when it comes to the resistance, which is supply greater than demand, this means that the price is going to be going down. The price is going to fall. So for the price to fall, that means that you should be looking forward to selling. So for you to enter to sell, it is going to be at the resistance. Don't forget, support and resistance is going to help us to know where to enter the market and also where to exit the market. And then before you know it, based on the price action, support and resistance, when you have an uptrend and then you have a downtrend, you should now be able to identify those areas where you want to enter in an uptrend and those areas where you want to enter in a downtrend. That simply means, based on this technical analysis, price action, support and resistance, ultimately is going to help us with the direction and also where to enter and also where to exit. We're going to show you an example now where we're going to be combining the fundamentals and technicals together, because both of them must align. I repeat, both of them must align in order for you to have a solid trade. Now we're going to look at an example of how to combine the fundamentals and technicals together. Remember, we said that two good heads are better than one. Now, if you look at what we have in front of us, now for these fundamentals, in 2018, we had a World Cup in Russia. We're using a scheduled news as an example, as this is something that happens every 4 years. And that means that if you understand this now, you will be able to take advantage of it in the next one. And this applies to every other thing, not just the World Cup. It could be elections, it could be Olympics, and so on. So the World Cup that we had in Russia in 2018, the currency is known as Russian ruble, RUB for short. Now ask yourself, would people be buying or selling the Russian ruble during the World Cup? What do you think the answer is? The answer should be buy RUB. Why would they be buying the RUB? They will be buying the RUB because there will be demand for the RUB. Why would there be demand for the RUB? There will be demand because there were a lot of people from different parts of the world in Russia in order to watch the World Cup. Interesting, right? Great. So they will be buying the RUB. Now that we know that we're buying RUB, now we're going to pair with the USD. And then we have the USD RUB. Now, as we have the USD RUB, the question is, are we going to be clicking on buy or are we going to be clicking on sell? Now, you already know that we're buying RUB. So that means that automatically we are selling the USD. So as you can see on the last line, we have sell USD in order to buy RUB. So that means that we are going to be clicking on sell. Now, this is the fundamentals for this World Cup in Russia 2018. And of course, we said we are combining the fundamentals and the technicals together. So as we have just looked at this, based on us clicking on sell during the World Cup for USD RUB, now we're going to cross over to the charts. The chart has to do with the technicals. And that means that we are going to be looking forward to selling. A quick one, where do we want to sell? Are we selling at the support or selling at the resistance? We are selling where? We are selling at the resistance. Great. So let's cross over to the MT4 now and look at the chart for USD RUB during the 2018 World Cup. Now, as you have the chart in front of us, you can see this is the USD RUB 1 hour time frame. And if you look very well, this was the start of the World Cup. So we put a box here, we put a vertical line here, and then we wrote start. And if you look at this bottom here, you can see 2018, so it's about June. Remember, it's for about 1 month period. And then coming over here to the end of the World Cup, where we put another vertical line, and then this box, you can see 2018 July, June to July period for 1 month duration. Now, from what we have right in front of us, let us investigate further, because now that we want to sell, the question is, where are we supposed to sell? We're supposed to sell at the resistance. But let me show you something quickly. You can see from where it started to where it ended. If we join the two together, you see that the arrow is pointing downwards. So what does that mean? That simply means that yes, indeed, it actually went down. So now let's look at how to identify this support and resistance so that we can sell at the resistance areas. Now look here, from the start of the World Cup, price went up, and then from here, price went down, went up rather, and then went down over here, and then went up, went down. What we're basically doing here is tracing what price did during the World Cup. We are following price in order to identify the levels. Now, from the start of this place here, what direction did the market go? It went up. So as it went up, what can we say we have here? Remember, when price goes up, it is what? It is support over here. And where the price goes down, this is known as what? Resistance. Beautiful. So we're going to now do something. We're going to mark this area with a vertical line, or rather with a horizontal line, as our area of support. And then we'll mark this one here as our area of resistance. So you can see that the story is getting clearer and clearer. So from this support area, price went up to this resistance, and then it came down. It came down close to the area of support, but we are not interested in buying. Don't forget, the fundamentals told us to sell USD RUB, and that means that combining it with the technicals, we want to sell at the resistance. So we're not going to do anything here. And then the price went up, and went up, but it did not get to this area here of resistance. It got to this point here, and then turned around, and then went back down, got to the area of support, and then broke out up to this point. Now you can see that the story is getting more and more interesting. Would have loved to have sold over here at the resistance, but price didn't get there. But instead, what happened? From this point, it went back, got to the support, broke it, and then dropped. Now, as price has broken the support here, the other side has now automatically turned to resistance. Whenever price breaks a level, the other side turns to the opposite. As here is support, we expect the price to be bouncing off support, but the moment it breaks out, this other side should now act as resistance, and that's what we have right over there. So now look at what happened. From this point over here, what do we now have? You can see that this now became what? This here became support as the price went up. So we mark this area as support, right? Now you can see what is happening. Now things are getting clearer and clearer. Here is the support. Then look at what happened. Remember, we want to sell and we want to sell at the resistance. Look at what happened over here. From here, price went up and got to this area of resistance. Yes, finally we are getting an entry to sell. That means that we didn't enter at the beginning. We didn't rush in because we needed to combine with the technicals. For those that rushed in over here and clicked on sell, what do you think would have happened to them? They would have had losses because the price went up. So we now waited until we got our entry over here. So finally, we're able to enter over here to sell. And you know our stop loss will be above over here. And of course, our take profit will be over here since we are selling and then we want the price to go down. So from what we have over here, you can see our entry. You know, we have price values over here to this right hand side. You can see all the price values that we have over here. That simply means that we entered at a particular price and then our stop loss will be at a particular price, and as well our take profit will be at a particular price. So the entry price and the stop loss price, the difference between the two of them will give us a stop loss in pips. Let's just call this X pips. I'm sure you should be able to do the calculation yourself, right? So the difference between the entry price and the stop loss price will give us our stop loss in pips. The same thing applies over here. The difference between the entry price, maybe it's this price over here, the difference between the entry price and the take profit price here will give us our take profit in pips. Let's call this Y pips, right? So we have X pips and then Y pips representing the stop loss and take profit. So we entered over here and entry to sell, and look at what happened. The price came down and then got to this point here, and then voila, we've made some nice pips. We've made some nice decent pips. Let's just call this X. Let's call this 30 pips, and then let's call the Y 80 pips. So that means that now we've made a nice decent 80 pips. And then from here, we've cashed out. From this support, don't forget we don't want to buy. We're only interested in selling. From this support, price now went up and up. Aha. Now you can see it went back to the area of resistance. So now we'll get our second entry. Yes, we'll get our second entry here. The same thing, stop loss of 30 pips and take profit of 80 pips. And look at what happened. Price went down, and then got to the support here where you could have cashed out for your 80 pips. But then look at what happened. It went further down and got to the area of, or rather, it got to the end of the walk-up, and somebody could have easily closed the second trade for even more than 80 pips. You would have made more. But the point here is that we are combining the fundamentals and technicals together. We are not rushing into the market like some people would have done over here. They would have rushed in to sell, and then when the price went up, they would have had losses. They might have even have crashed their account, only to see the end of the walk-up at this bottom here. It would have been so painful. But we patiently waited for the fundamentals and technicals to align. We got an entry here, and then we got another entry over here. Now, I even want to ask another question before we end this example. Now that the walk-up has ended over here, what do you think people will be doing to the RUB? Let me write this over here. What do you think people will be doing to the RUB currency? Would they be buying it or selling it at the end of the walk-up? If you think about it very well, they will be selling. Yes, they will be selling because they don't need the RUB anymore. Exactly. They don't need it anymore because they are all going back. Everybody is going back to their own country. So now what do you think people will be clicking on for the USD RUB? If you think about it very well, remember the USD now, we're selling it here. So I put an S on top. And then USD we're buying. We're doing the opposite, obviously. So that means that we're clicking on what? That means that we're clicking on a buy. So that means that as we're clicking on a buy, we're now expecting the price here to push higher after the walk-up. We're expecting the price to push higher after the walk-up. So let's do something. Let's clean this up. It's beginning to look a bit messy. Please look at this very well. Understand how we're able to combine fundamentals and technicals here in order to have a nice solid trade. So let's clean this up and let's put an arrow here pointing upwards, as after the walk-up we are interested in what? We are interested in buying USD RUB. So let's move forward and let's find out whether it actually went up. Let's see. Beautiful. Now you can see what happened now. After the World Cup, yes indeed, price did what? Price went up. That means that we could have made money after the World Cup, just like we could have made money during the World Cup. Once you understand this information and you know how to combine the fundamentals and the technicals together, then you will definitely be able to make good money at the end of the day. This is just one example. You can use different examples. You can use the example of the coronavirus effect on the Netflix, the example that we gave earlier for the fundamentals. You can cross over to the technicals, go back to March 2020 and look at what happened during Netflix during that period. That same period, check on the crude oil as well on the technicals and merge the two of them together. Do your own little exercises, do your own little assignments, your own practicals and so on, and then you will see that you can easily combine the fundamentals and technicals together to have solid trades, right? Now from what we have just done here, you need to practice this. Watch this video over and over and over again, and of course it will make sense the more you do it. Okay, thank you, and let's continue. Risk management. Risk management is going to help us to minimize our losses and then maximize profit. I repeat, risk management is going to help us to minimize losses and then maximize profit. And we are going to be looking at how to determine the volume, how to determine the lot size, also what is leverage, what is equity, and what is margin, all under risk management. So when it comes to determining the volume, the lot size, you need to know this formula. This is a formula that's going to help you to determine this, and the formula for determining the volume is the amount that you are willing to risk per trade divided by stop loss. Remember, we talked about the stop loss not too long ago. Multiply by 1/10. 1/10 in this instance is a constant K. It is always there. 1/10 is a what? Is a constant in order to determine the proper volume. Now let's help you out further. Now for you to determine the amount that you are going to be risking, first of all, you need to first of all know your account balance. How much is in your account? As an example, let's assume your account balance is $1,000. So how much of this $1,000 do you want to risk? That is the question. We normally advise that you risk in percentage. You could be 1%, 2%, 3%, 4, 5, 10, whatever percentage that you're comfortable with. Well, we would always advise anything around 1% is still very okay. So now you want to risk 1% on this particular trade, and that will give us what? 1% of $1,000 will give us $10. 1% of $1,000 will give us $10. So now we know the amount that we're willing to risk on this trade, $10. Then the stop loss. Let us assume our stop loss is 20 pips. To get your stop loss is going to be from your analysis. Once you carry out your analysis based on technicals, it's going to help you to know how many pips you are going to be using for stop loss and how many pips you are going to be using for take profit. So now that we've gotten our amount that we're willing to risk per trade, and then now we know our stop loss, we now plug it in, and then it's going to be 10 divided by 20 multiplied by 1/10. Don't forget the 1/10 is a constant. So we can easily say 10 divided by 20 times 10, which is 10 divided by 200. And by the time you do the calculation, I would always advise you use a calculator so that you don't make a mistake. Making a mistake simply means you could end up losing way more than you bargained for. So now, for this formula, the volume is now 0.05. The volume is now 0.05. But I will not stop at this. I want us to confirm this 0.05, if we put it into the volume section before we place our trade, is it really going to amount to $10? We need to confirm that. In order for us to confirm this, we have what we call a lot size table. We have a lot size table that will help us to know whether that 0.05 is actually correct. For this lot size table, we have different lot sizes: the standard lot size, mini lot size, and the micro lot size, and they have their own starting volume. The standard starts from 1, that is 1 standard is 1, 2 standard is 2, 3 standard is 3, and then we have the mini, 1 mini is 0.1, 2 mini is 0.2, 3 mini is 0.3, 4 mini is 0.4, and so on. And then we have the micro. 1 micro 0.01, 2 micro 0.02, 3 micro 0.03, 0.04, 0.05, 0.06. I'm sure you get the gist of it now. And then they have their own pips value. How much will it cost per pip on each section? For standard, it's going to cost $10 for every pip. For standard, it is going to cost $10 for every pip. And then for mini, it's going to cost $1 for every pip. Mini is going to cost $1 for every pip. And then micro is going to cost what? Micro is going to cost 10 cents for every pip. Micro will cost 10 cents for every pip. So we need to know this lot size table. The volume we got was 0.05. So we need to find out 0.05, where does it fall under? It falls under micros. Great. How many micros is that? 5 micros. 5 micros is 0.05. Remember, 1 micro is 0.01. So that means that 2 micros 0.02, 5 micros 0.05. So if it costs for 1 micro, it costs 10 cents to 1 pip, 10 cents to 1 pip. That means that for 5 micros, it will now be 50 cents to 1 pip. 50 cents to 1 pip. And then our stop loss is what? 20 pips. 20 pips. So at 20 pips, how much would that now cost? 50 cents to 1 pip. How much will it now cost for 20 pips? If you do your maths, your cross multiplication, where it costs 50 cents to 1 pip, and then for 20 pips, it will cost what? For 20 pips, it will cost $10. If this is what you got, then that means, yes, indeed, your 0.05 is correct. Most traders normally make that mistake, and then from that mistake, they end up losing more, and of course, it ends up being very painful. Now that we've gotten that, we need to also look at how to maximize profits. You minimize losses and then you maximize profit. For you to maximize profits, you need to understand the risk to reward ratio. When we say risk to reward ratio, we're also talking about the stop loss to the take profit ratio. Stop loss to take profit ratio. And then when it comes to stop loss, as an example, the first one that we have here, assuming your risk, which is your stop loss, is 100, can your take profit, your reward, be 10? The answer is no. One major golden rule that I always tell people when it comes to maximizing a profit is, when you carry out your analysis, always ensure that your reward, your take profit, is greater than your risk stop loss. If it is not greater, don't take that trade. I repeat, don't take that trade. So when it comes to 100, the risks, and then 10 the reward, it's not a good trade. Don't take that trade. When it comes to 100 the risk, 50 the reward, don't take that trade. When it comes to 100 risk, 100 reward, this is not a good trade. Some might say, well, no winner, no loss, but it is not a good trade. And I'm telling you, this is not how to trade. You must always ensure that your reward is greater. The higher the reward is with respect to the risk, the better for you. So if you have 100 to 200, good. 100 to 500, better. 100 to 1,000, awesome. 100 to 1 million, wow, beautiful, awesome, great. All of it mixed together. So make sure that when you are carrying out your risk to reward ratio, ensure that your reward, which is your take profit, is always greater than your risk stop loss. Else, don't take that trade. Else, don't take that trade. Very, very important. When it comes to leverage, leverage is a two-edged sword. Leverage is the way you magnify your positions, meaning that you magnify your positions, you can magnify your profit, and you can also magnify your loss. The higher the leverage offered by a broker, and of course, the higher the profits you would make, and also the higher the loss you would also make as well. But you don't need to be scared of this leverage, no matter how high, how heavy the leverage is. Now look at it this way. Leverage is like the speedometer in your car. If your speedometer in your car is up to 200 kilometers per hour, Are you going to finish the speedometer? Can you finish the speedometer? You know, someone that tries to finish the speedometer is asking for trouble. So what do? With the speedometer you have, with the leverage that you have, you do what? You just place your trades according to your volume calculation. Don't try to take too many trades. Don't try to be a hero. Don't try to make $1 million overnight. It is a recipe for disaster. It is a big recipe for disaster. Once again, leverage is a two-edged sword. It can help you to make more money fast, and it can help you to also crash your account even faster, right? So you need to understand leverage. Do not be afraid of leverage. Whatever you do, just ensure that you are not putting in way too much trades or using a big volume that is too heavy for your account balance to carry. That's why the leverage and the volume lot size calculation, they go hand in hand. Equity. The equity is simply the account balance and what you have based on your open positions. Your open positions could either be in profit or could be at a loss. Your equity is the account balance and what you have based on your profit and loss positions, open positions. That's the equity for you. And then when it comes to the margin is the required equity to open a position. Let me explain this margin a bit more. Let's assume you have $100 account, and then you place a trade, and that trade, the margin required is just $2, right? So that means that you have more or less a free margin of about $98. Now let's assume you want to place another trade, and then the other trade of this instrument in particular, the margin required is 200. Of course, you cannot place that trade. So the margin is that required equity, the required money, the required, capital that you have in order to open new positions. So you need to know the instruments you are trading, know the margin required to open a position based on this instrument or that instrument, because they vary. As an example, if you have an instrument where the margin required is $2 and your account balance is what? $100. That means that you can place a good amount of trades on that same instrument. But if your margin required is $200 and your account balance is $100, of course you cannot place any trade whatsoever. Something that is very important for us to take note of. Psychology of trading. Trading psychology, very important. This has to do with controlling of your emotions. Trust me, this is a big aspect that traders have issues with when it comes to controlling of emotions. And then we have different emotions that we go through. We have the happy state, the angry state, scared, and of course the sad state. And these emotions, they tend to get the better of us at the end of the day. And that is why you need to take charge. You need to take control of your emotions. Else, your emotions will get the better of you and then control your trading, control you like a puppet. Don't let your emotions get the better of you. I repeat, don't let your emotions get the better of you. So how can you control your emotions? People normally say when it comes to the psychology aspect of trading, it's not easy to control your emotions and so on. But there are things that you can do that would help you. Trust me, there are things that you can do, that you will do, that would help you to control your emotions tremendously. Now, having a trading plan, having a trading journal, trading management, and of course a trading goal would help you to control your emotions, your trading psychology. Very important. When it comes to the trading plan, it's going to help you to know the instruments that you are trading. It's going to help you to know the time frame you are using. A plan is a set of rules, is guidelines that you are going to be implementing. And of course, if you don't have a plan, your trading is going to be anyhow. And if your trading is anyhow, your result is going to be anyhow. So once you have a trading plan that comprises of you knowing the instruments you're going to be using, the time frame, your risk, the trade sessions. When we say trade sessions, remember we talked about Sydney, Tokyo, London, or New York. Your style of trading, whether you're a scalper, intraday trader, swing or position trader, type of trader? Are you a trend trader trading with the trend, or are you a counter trend trader going against the trend? All of these things based on the trading plan are very, very important, and they're going to help you tremendously to be in control. This trading plan also, you can even add number of trades per day, meaning that you take only 2 trades per day. It's going to help you to look for the best or the best, wait for the best or the best trades to come your way. You're not going to be taking any half-baked trade based on your trading plan. That is why this trading plan is very, very important in order to be able to take control, to be able to take charge of your emotions. Trading journal. What is a trading journal? A journal is a diary. Diary is keeping records. What are we keeping records of? We are keeping records of our trades. Your trades that you have taken, the result, the outcome, and so on. Why do we need to take records of our trades? You're going to take records of your trades. Most importantly, don't take records of your trades on paper or book. I would always advise take records of your trades. Your trading journal should be on an Excel sheet. When you keep records of your trades, assuming for 3 months, you keep records of your trades for 3 months, you have your winners, you have your losers here. You can separate them, put winners on one sheet, put the losers on the other sheet, and then you start to review those trades. For the winners, as you start to review, you'll notice something that, oh, out of these 5 instruments that I trade for my trading plan, this particular instrument has been giving me my best winner. What does that mean? That means that that is the instrument that you are going to focus on. This instrument has been giving me my best winner. That means that that is the instrument you are going to focus on. And then you now notice, oh, it has been giving my best winner on a Tuesday, or maybe on a Wednesday, or a Thursday, or at a particular time. That means that you are going to focus on that instrument at that particular time, that day of the week, even the time of the day. Your best trades, do they come at 10 a.m. to 11 a.m.? Do they come at 1 p.m. to 3 p.m.? The timing is very important. So that means that this trading journal, once you keep records of your trades, it will help you to know when exactly you are supposed to be trading. Earlier we said you don't need to trade 24 hours a day. Once you use this journal, it's going to help you to determine exactly when you're supposed to be trading. Very important. And when you go over your losers, it's also going to help you to know when not to trade, because you know when you have most of your winners, and then you start to avoid when you have most of your losers rather, and then you start to avoid those losers, those losses. These are things that we need to do. We need to understand based on the trading journal, and to help our trading to improve, to catapult to the next level. How do you manage your trades? Very important. Most traders don't know how to manage their trades. You can manage your trades whether it's a winning trade or it's a losing trade in either of these 2 key ways: partial close or trailing stop. And you have the manual and the automatic partial close. You have the manual and automatic trailing stop. I'm going to show you with examples how to set them so that you know how to manage them appropriately. If you are listening to me and you don't know how to manage your trades, then there is a problem, right? Because once you place a trade, you must know how to manage it, whether it's looking like a winner or it's looking like a loser, either of the two. Now, when it comes to the trailing stop, we have the manual trailing stop, and also we have the automatic trailing stop. Now you can see where the stop loss is. You can see we entered here to buy, and the trade has gone in our favor. For the manual trailing stop, when it goes in your favor, I can manually move the stop loss higher, and then when it moves more in our favor, you can continue to move the stop loss higher as well manually, and when it moves in our favor, continue to move the stop loss higher and higher. So that is the manual way. Now for the automatic way, using the trailing stop, I'm going to right click here on where we have the trade, and then move over to the trailing stop over here. Now when we have 50 points means 5 pips. When we have 60 points means 6 pips. So if I want to use custom and I want to set a 20 pips trailing stop, that will be 200. This simply means that when it moves in your favor, right, it's going to trail it by 20 pips, meaning that if it moves 20 pips in your favor, it will adjust the stop loss by 20 pips automatically, and then it will be trailing behind by 20 pips. Now let's even reduce this. Let's reduce this to maybe like 5 pips or something, so that we could see it work. So for 5 pips, remember 5 pips is 50 points. So if I click on 50 points, let's look at what happens. You can see that automatically it moved by itself 5 pips behind this one. But this is way too tight. So when you're going to be using the trailing stop, the automatic or the manual trailing stop, make sure that you are using something that is not too tight. Now I need to adjust this quickly because it is still on 50 points and it will still be too close. You can see as I'm talking, it quickly adjusted again. So I can delete it, right? And then to delete the automatic trailing stop in order for me to take over and let it become manual again. So this is how to make use of the trailing stop, the manual trailing stop, and also the automatic trailing stop. Now when it comes to the partial close, you can see that we placed a trade with a size of 0.05, and then the smallest lot size is 0.01. That simply means that I can close this 5 times, 0.01, 0.01, 0.01, 0.01, and 0.01. So you can close this partially, manually, or the automatic way. Now for the manual partial close, for me to do that, all I have to do is to right click on this trade and then go over to modify. Yes, I know we want to close this partially, but we click on modify, and then when we click on modify and then this pops up, instead of modifying, we will change this to market execution. Yes, change to market execution, where I can now click on close. But this time around, I'm going to adjust it to the lot size I want to close. You can see this is the manual partial close. So if I click on 0.01 and then I click on close, that means that I am closing only 0.01 and then it will remain 0.04. So let's do that now. We click on close and look at what happens. Aha, you can see it remains 0.04. Now you do this when the trade is moving in your favor, obviously, right? So as it's moving in your favor, you do another partial close, and this is the manual way. So if I want to close 0.01, another 0.01 manually, probably when it has gotten to maybe TP1, then TP2, then TP3, TP4, and TP5, as it is moving in your favor, you can now go back, right click on that trade again, click on modify or delete order, and then when this opens up, you now change this to market execution, and then come here and select the volume you want to close, and then click on 0.01. That means that if we click on close here, it is going to close and then it will remain 0.03. Let's do that again. We click on close. Voila, you can see it now remains 0.03. Now in this case where we have just shown you the manual way, for the automatic way, if you want to close it maybe 3 times and you want to use 0.03 for the automatic way, it simply means that you're going to break this 0.03 into 3 trades. That simply means that you, when placing the trade from the very beginning, you would easily change this to 0.01 and then you click on buy 3 times, right? Now the fastest way to do this, you could use this from here. So you can click on buy 3 times and then you could do buy 1, 2, 3. So that means that you can quickly place 3 trades to buy 3 times very fast. And you can see we entered at the exact same price. So you could use this to quickly enter the trade 3 times, and then you set the same stop loss for all of them, but then set different take profits. Meaning that when it gets to TP1, this first trade will be on TP1. When it gets to TP2, the second one is TP2. And when it gets to TP3, then the third one is on TP3. And then automatically, your system doesn't have to be on. You don't have to be in front of your system. It will start to close by itself. So this is how to do the automatic partial close. and we also showed you the manual partial close. So this is how to manage your trades, especially when it is going in your favor. So when a trade is going against you, never ever move your stop loss against you. I would advise let your stop loss get hit, or if you don't like the trade anymore, you can close that trade before it even gets to your stop loss. But never ever move your stop loss against you. That simply means that you'll be incurring bigger losses. So we've just talked about how to manage your trades using the partial close and also using the trailing stop. And you must have a trading goal. This trading goal, the problem with most traders now is that they have this trading goal at the beginning of the trading, but then you are meant to have this trading goal after you have implemented the trading plan, the trading journal, trading management, and all. Because most traders today, they say, oh, I want to make $100. I want to make $1 million every day. I want to make X amount of money, X amount of pips every day. But it's not possible. Why? Because the market might not give you opportunities every day. And that's why this trading goal, you can only determine your trading goal after you have implemented the trading plan, trading journal, trading management, trading everything, and then you have a healthy trading goal. Very, very important for everybody to take note of. Now, traders are facing a lot of problems today, and we're going to list a few of them. Now, most traders, as I mentioned this, if you are guilty of this, then you know exactly what we're talking about. Most traders have that issue when it comes to stop loss. Either they're not using a stop loss, or the stop loss is too big, or maybe they use a stop loss that is too tight and then it gets knocked out and then they decide not to use a stop loss. That is not the way to trade. Understand your trading, know where your stop loss is meant to be, and then trade accordingly to your plan. Remember, everything must be in your plan as well. So patience, discipline. A lot of traders lack patience, they lack discipline. Lots of traders are also fair and have that aspect of greed. Let me tell you, in this business, greed is a killer. And greed is what is going to make a lot of traders to what? It's going to make a lot of traders to increase their lot size, to trade without stop loss, and to do a lot of funny things that you wouldn't do normally. And then a lot of traders overtrade. You want to make $1 million overnight, you place too many trades. You make use of that leverage. Don't forget, we said the leverage, like the speedometer, 200 kilometers. You cannot finish it. You try to finish it, you're trying to place too many trades. And you place too many trades, you have too many losses, you get angry along the way, and then you tend to revenge. You want to revenge. Revenging never ends well, and I'm sure you understand what I'm talking about. Whenever you revenge, it doesn't end well. You will end up losing more and even bigger. Fear of missing out is a killer. Poor risk management is also a killer. As we've explained all of these things now, it is for you to implement them. You must have the right mindset, emotions. You must have the right attitude. This has to do with the psychology. If you notice, everything we've been talking about now, based on the strategy, based on risk management, based on psychology, has solved all these problems that traders are facing here. So this course, this video, you would have to watch it over and over and over again. And don't forget, if you need that mentorship, reach out to me and then we'll see how we can work together. The road to success doesn't have to be difficult. You need to get the proper education, the proper training, and that's what we have just delivered to you now. You also need to practice. The more you practice, the better you will get. Practice, practice, practice is the order of the day. And of course, you need a mentor. Mentor is someone that will show you the ropes. A mentor is someone that will guide you. A mentor is someone that would assist you further. And then finally, you get to that aspect of your money, your reward. And this is something that traders fail to follow. Trust me, you don't follow this, it won't end well for you. You can't do anything in life without education, without training. That's why we all go to school, right? We go to school in order to understand the ropes of how to go about this, how to go about that, and then we put it to practice. And of course, you need a mentor that will help you further. Now, let me ask a quick question. Assuming you were trying to get to the 25th floor, would you use the stairs or will you use the elevator? I repeat, you're trying to get to the 25th floor. Will you use the stairs or will you use the elevator? I know this building is looking more than 25, but it's looking more than 25 floors, but no problem. Just understand what we're trying to say. And of course, for that question, will you use the stairs or elevator? I already know it's a no-brainer. You definitely do what? You definitely use the stairs. Why would you use the stairs? Because, did I say stairs? I'm sure you must be thinking, what did I just say? Of course, you would use the elevator. I'm trying to find out if you are still together. You will not use the stairs. It will take you a longer period of time to get to your destination. But once you use the elevator, fast speed, it will help you to get there faster. Stairs or elevator? The answer is elevator. With speed, you get there in good time. So of course, as you pick the elevator, it simply means that you want to get there faster. I believe you want to get there faster. Your answer should be yes. So if you want to get there faster, that elevator is the mentor. I repeat, the elevator is the mentor. So you need the elevator. That means that you need a mentor. And a mentor is someone that will give you live market analysis. That's what I will be doing for you. That's what we'll be doing for you. We'll be giving you live market analysis as the market is open. We'll be giving you daily market updates. What's happening in the world at large with the corona, with the inflation, with the geopolitical issues and so on. What direction is the market heading to? We'll also give you trade setups for you to look at, and then we'll more or less trade together. We'll give you a ready-made trading plan, plug and play, ready-made journal. You just put in your positions, your trades that you've taken, and then of course we'll give you a calculator for the risk management aspect. So you just punch in your account balance, punch in your stop loss, punch in your percentage that you're willing to risk, and then the calculator will do the rest for you. We'll also give you playbook cheat sheets that would help you to what? Help you to know what you're looking out for immediately. And you also have Q&A sessions. And this is what we will do for you. This is what a mentor will do for you at the end of the day. So you can see how important having a mentor is at the end of the day. Now, you need to reach out if you need mentorship or if you have any questions whatsoever. Reach out and then we will fix something for you and see how we can help you to improve, to get there faster. Don't forget, you are using the elevator, you're not using the stairs. The stairs will take you a longer period of time. It took me years, so I know what I'm talking about. So it doesn't have to take you years. Within a few months, you'll be there in good time with the right guidance. So with that said, we want to say thank you for staying tuned from the beginning to the end of this course. Please watch this course over and over again. As I said at the very beginning, it promises to be enlightening, and I'm sure you have been well enlightened about the business of Forex trading. And of course, you can use this information to trade any instrument of your choice, whether it's the cryptocurrencies, whether it's the equities. Trust me, you can definitely make money. So thank you, everybody. Ensure to trade safely. May the peace be with you. I always want to say that. I like saying that, just like a Jedi. May the peace be with you. May the force be with you. And I'm sure I'll get to hear from everybody soon. Thank you. Goodbye. And of course, God bless.